Greetings. On behalf of Mayor Bracey and WRCT Studios, my name is Michael Dowry, and I'm here to talk about pensions and how it impacts our general fund budget. First, I want to give you the breakdown of revenue coming into the city. Due to state-imposed limits on earned income tax, local service tax, and business privilege taxes, real estate is the only section where enough revenue can be raised to cover operating expenses. Couple this with a stagnant real estate tax base that is not appreciating through natural growth, and we are left with a situation where the only way to raise revenue is to raise the rates. This further perpetuates the vicious cycle of over-reliance on real estate tax. Efforts are further hampered by reduced grant funding from federal and state sources. In 2004, real estate tax made up 33% of our operating revenues in the general fund. Fast forward 10 years later to 2013, and that real estate tax now comprises 42% of the operating revenues. On the other side of the equation, costs have remained fairly constant outside of public safety. Public safety includes our police and fire departments. Costs have grown from 62% of the budget in 2004 to comprising 73% of the budget in 2013. These graphs illustrate that there are more retired individuals from the police and fire sectors that are receiving benefits from the pension fund than there are active employees contributing to the fund. This situation is not unique to York. The same problem persists with Social Security on the federal level and the pension reform fight on the state level. Despite police and fire retirees receiving pensions that average about 50% of active duty salaries, while all others are closer to 25%, these pension costs continue to rise at an alarming rate. These three pie graphs show the current status of our pension funds. As of December 31st, 2013, the cumulative total of assets in the fund represented about 58% of the liabilities. What does that mean? It means that there are not enough funds or there are not enough assets within the pension fund to cover projected liabilities. The red represents the unfunded liability, meaning how much we need to contribute in today's dollars to bring the fund to a fully funded status. As of 12/31/13, our pension fund was underfunded by $65 million. In addition, this does not include the $36 million outstanding on the pension bond from 1995. At that time, the city borrowed money to fully fund the pension. Due to poor market performance, in combination with several arbitration rulings against the city, we find ourselves $100 million behind in pension funding. This graph illustrates the annual increases in the pension fund since 2009. In 2010, York City elected to take advantage of the state program that reduced our minimum required payments into the fund by 25%. The hope was that this 4-year program would allow enough time for pension reform to happen, but that hasn't taken place. With the expiration of this 4-year program in 2014, the city now faces a $2.4 million increase to the annual required payment obligation. In addition to the $2.4 million increase in required payments, the city must also cover a $345,000 increase in the pension bond payments. Both of these are scheduled to go into effect for 2015. However, there is a unique alternative offered to us by the state under Act 205. This act allows distressed municipalities to raise their earned income tax rate beyond the state-imposed limits and to apply that rate to non-residents as well. This earned income tax increase would apply to 3 groups: York City residents with earned income working in the city, York City residents with earned income working outside the city, and non-York City residents with earned income who work inside the city. It is important to note that this EIT increase will not apply to Dover, Northern, and Southern school districts residents working in the city. since their current EIT rate already exceeds the proposed increase to the York City rate. Dover, for example, is currently at 1.4%. If the city were to increase its rate to, let's say, 1.25%, that still would be under the Dover rate, and all taxes would continue to go to Dover. On the flip side, if the city raised the rate to 1.5%, then that 0.1 difference, 1.5 minus the 1.4, that difference would be forwarded to the city. Taxing non-residents is a countermeasure to overcome the effects of suburban sprawl. Our antiquated tax structure is not able to overcome the decades-long trend of residents relocating to suburban neighborhoods. In our case, 88% of the income generated within York City is earned by non-residents. So the question becomes, would York City residents prefer property tax increases or increases to the earned income tax rate? The answer depends on the assessed value of an individual's property and their level of earned income. If the city were to raise the rate to 1.25%, the current rate is 1%. If the city were to raise that rate to 1.25%, this table here illustrates what that change would mean to an individual. Using the $50,000 line item as an example, an increase of 0.25% would translate into an additional $2.40 per week for that wage earner. The annual change will be an additional $125 paid in earned income tax. Conversely, an increase of 0.27% to the property tax would be needed to yield approximately the same amount. Using the $50,000 line item again as an example, the previous graph showed us that that would translate into $125 in annual tax increase. Using that same line item, if a property were assessed at $50,000, the annual tax change will be $135.14. The difference isn't that much, but what makes this unique is that that additional earned income tax would receive contributions from non-residents as well, meaning that approximately 2/3 of the income generated from this tax would be paid by non-residents. As you can see, pension funding is one of the largest drivers of financial challenges facing the city. A public safety tax, as it's been termed, would mean a 0.25% increase in the earned income tax. It is important to note that this additional funding deals only with the increase in required pension funding and can only be used for that purpose. Significantly unfunded pension liabilities, pension debt, and other post-employment benefits still need solutions. If you have any questions or comments, my colleague Mike Johnson and I can be reached via email or phone. Our email addresses are first initial, last name @yorkcity.org. That's mjohnson@yorkcity.org, or mdowry@yorkcity.org. That's MDOWEARY. Or we can be reached by phone at area code 717-849-2237 or 849-2263. Thank you, and have a nice day.